Hey everyone, welcome back to the Crypto Deep Dive, where we go beneath the surface of everything happening in Web3, DeFi, and digital assets. I'm Laurie.
And I'm Nick, and today we're exploring a big trend that's making waves across both crypto and traditional finance: real world asset tokenization. It's a mouthful, but trust us, it's one of the most transformative shifts happening right now.
Before we get fully started, let's do our usual spiel and look at the markets. Today, Monday, 5 May 2025, things stand as follows. Bitcoin stands at 94,602 US dollars. Ethereum is sitting at about $1,815. XRP is at 2.1267. We've got XLM at just under 26 cents. Solana is at around $146 and ADA is trading at around 66 cents. All right, Nick, let's kick it off. What exactly is real-world asset tokenization and why is everyone suddenly talking about it?
Great place to start. Real world asset, or RWA tokenization, is the process of taking physical or traditional financial assets, like real estate, gold, US treasuries, or even fine art, and turning them into digital tokens on a blockchain.
So, I could own a piece of an apartment building or a gold bar, but digitally?
Exactly. Instead of needing hundreds of thousands to buy a full property, you can own a fraction of it through tokens. It breaks down huge assets into smaller, tradable pieces, unlocking liquidity and accessibility.
And what's the upside to doing this on a blockchain versus, say, in a traditional fund?
There are a few big benefits. First, liquidity. In traditional markets, assets like real estate are super illiquid. It can take months to sell, but tokenized assets can be traded in real time. Second, fractional ownership, which we mentioned. Third, transparency. Blockchains offer immutable records of ownership and transactions. And finally, efficiency. Smart contracts automate processes like dividends, repayments, and compliance checks.
Sounds like a win-win, but it can't all be smooth sailing. What are some of the challenges here?
Definitely not smooth sailing yet. There are still regulatory grey areas. Governments are figuring out how to classify these assets. Security is also a concern. If the smart contract behind a tokenized asset has vulnerabilities, it can be exploited. And then there's adoption. Legacy systems in traditional finance aren't built to interact with blockchain infrastructure yet.
Let's talk about who's actually using this. Are we seeing real adoption, or is this still experimental?
It's becoming very real. Institutions are now on board. BlackRock, Franklin Templeton, and even JP Morgan are exploring tokenization. We've already seen tokenized versions of US treasuries, real estate deals happening on-chain, and even luxury goods like wine and watches being fractionalized for investment.
Wild. So the crypto world and TradFi are starting to blend?
Exactly. We're seeing a bridge being built between DeFi and TradFi, traditional finance. For example, tokenized treasuries offer stable, yield-generating assets on-chain. That's attractive not just to crypto-native investors, but to institutions who want exposure with blockchain speed and transparency.
All right, let's dig into the regulatory side. If you're tokenizing assets, what laws do you need to worry about?
A lot depending on the jurisdiction. In the US, securities laws come into play, so tokenized assets often need to be registered or qualify under exemptions. Europe's a bit more progressive with things like the MyCA framework, but it's still evolving globally. KYC, Know Your Customer, and AML, anti-money laundering requirements are key too. Platforms need to identify users and prevent illegal activity, even in decentralized systems.
So how do you balance that? Decentralization on one hand, compliance on the other?
It's tricky. Some projects use permissioned blockchains or hybrid models where parts of the system are open but identity and compliance are tightly controlled. Tools like Chainalysis are also helping track blockchain activity to spot illicit behavior. So we're seeing a merging of Web3 ideals with regulatory realities.
Let's talk tech. How is this all actually built?
At the heart of it are smart contracts. They define who owns what, automate payouts, and handle transfers. Ethereum is a big player here, but so are faster enterprise-focused chains like XDC and Avalanche. Some projects are exploring hybrid chains that balance public transparency with private data control. The technical promise is composability. You can plug tokenized assets into DeFi protocols for borrowing, trading, or yield farming. Plus, settlement happens in minutes, not days like in traditional markets.
Okay, Nick, let's talk future. Where is this headed? What's the big vision?
The big vision? Trillions of dollars in tokenized assets. Citigroup even predicted that up to $5 trillion in traditional assets could be tokenized by 2030. Imagine every stock, bond, mortgage, and artwork on a blockchain. Instant transfers, programmable ownership, global access. But there are limits. Not every asset is easy to digitize. Legal enforcement, custodianship of physical assets, and scalability issues still matter. We'll likely see more hybrid systems evolve, where on-chain data is linked tightly to off-chain infrastructure.
Final question for today. Is this hype or is this the future?
It's both. There's definitely hype, but there's also substance. Tokenization isn't a fad, it's infrastructure. The rails are being laid for a more efficient, open financial system, but it'll take years to reach maturity.
All right, you heard it here. Tokenized real-world assets are no longer just a buzzword. They're a building block of the next-gen financial system.
Exactly. Watch this space, it's just getting started.
That's it for today's deep dive. If you liked the episode, don't forget to subscribe, leave us a review, and share it with your crypto-curious friends. Catch you next time on the Crypto Deep Dive.
Absolutely. On the Crypto Deep Dive. Have a good one, everyone.